Now we can turn to my favorite topic, which is U.S.-China trade war and just looking at U.S. trade overall, just because we're going to go through what does the trade balance look like, hashtag it's ugly. And here it's just, we're going to kick off with U.S. goods, exports, imports on an annual growth level. So again, if you think about imports, we showed on in previous shows how things coming into the West Coast have improved coming in from Asia. You can see here how imports have spiked. And when we look at just the general growth, the imports have been there on a aggregate level. Exports continue to be slow, even with a big pickup in not only oil, but also grains. It's just the exports aren't there, which is why we have such a steep imbalance. Now, this is coming even when we had the dollar fall, imports were rising. And as we talked about in the EIA show, that's because we are backfilling the overall supply chain, as we saw with the big increase in inventories on the corporate level, which actually beat estimates. It's companies are essentially rejuvenating and backfilling their overall inventory, which is pulling in more imports. The problem is we're not seeing those increase in exports, and the U.S. and China just isn't buying as well to the rate they're supposed to. Now, just to put it into perspective, as we look at U.S. trading goods balances based on the on total census basis, you can see that this is the worst that we've had since 1989. And when you go back even through the financial recession, you can see that we're just at a point where imports continue and we're just not getting that export side. And the problem is exports will remain slow. They continue to remain slow as China picks up more of the global trade. We've seen Japan see a little bit of an uptick. They remain depressed. South Korea has had the biggest shift to the upside on exports, but Germany and other nations continue to struggle. And as you can see here, our exports continue and remain under pressure. Now, I always will avoid talking about politics and especially opining on whatever that was last night in terms of a debate. But when people push back and say, well, civil war and this, I just want to be very clear. There is a common enemy or a common threat that continues to permeate the news, and it will only incentivize or unite the populace. And we're bringing to light, and other people are starting, and by other people, I mean governments, countries are starting to realize the problems with China and the kind of tactics they use. And this is interesting because this is looking at America's views on China. And you can see it's continued to get worse. It kind of, balanced out when you look at what I call the Rose Garden lie, when we saw what China was doing in the 9-dash line at the Spratly Islands. And then in 2016, it kind of peaked and then dipped. But now people are looking at this more and more unfavorably and blaming more on China. Obviously, there's COVID. Now you have what's happening in Western China with forced work camps. We're having that again in Tibet. The narrative is shifting, and there are less and less people that don't know or that have the favorable view. And this is going to become a uniting factor. Regardless of who wins the election, we're going to see a certain amount of unity come together and really hone in on this. And what we're going to talk about now as we shift to really Asian trade and what's happening in terms of consumption, keep this in the back of your mind as you consider how maybe you view China, maybe how you're taking and looking at this on a go-forward level. Because I have my views, and I've been very clear with where I think this all ends up. But I think it's worth considering as we go into a very contested, or at least a very interesting election come November. And before we look at that, as someone else who is having issues with China, and we're starting to see more and more, is India. And when we keep talking about, especially in the last segment, on how India GDP is going to remain a concern, here's an example of why those Indian data points are concerning, is because the consumption continues to fall across the board. That's consumer confidence, that's non-gold, non-oil, that's auto sales. The pressure remains throughout the all of India, which is why we believe that there is going to be additional downward movement on GDP. But at the same time, it also speaks to what's happening between India and China, because India is actually a very big trade partner with China. So not only do you have a struggling economy, but now you have a rising conflict that we've covered at nauseum in terms of China, India, Ladakh, Sikkim. So this is something to consider when we're looking at some of the big trade partners with China. Now, when we shift, and go much deeper into what's happening with U.S.-China, here you can see just the trade balance and how the trade balance shift is moving in the wrong direction and it's continuing to widen. Where China is just not taking what they're supposed to. U.S. is buying more than I don't want to say what they should. But you have a lot of that backfill happening, and based on the data we're seeing, there's really nothing to change this trajectory, also because this is also factoring in that big increase in grains. Now, given it's a rolling 12 months, we will get a little bit of an uptick, but again, it's even though we're seeing more in grains, we're seeing less in other things, which again is going to offset, which is why it's going to be a net negative. And when we think about China, it's not just the U.S. China has taken, this is looking at the share of world exports. Since COVID, they've taken a huge percentage. And if you think about this, I mean, they've taken almost 6 percentage points of global trade throughout COVID as countries that were typically big exporting nations, coming back to why we were concerned about emerging markets, the pressure there. They continue to take away that trade because they're either struggling over COVID, trying to stimulate the economy, trying to do something, and China has stepped in to fill that void. Now, even though China has really projected this growth and projected this strength and recovery, it's when we look at the Chinese tourist and what's happening within China itself. Because even though China has shown great, strong exports, imports have been down. And now we're starting to see those outbound tourists. Look at the Chinese tourists. And the last time you were, a tourist yourself, and how many Chinese individuals were around you. Look at the drop-off. The drop-off is essentially near 100%, and it's going to continue to weigh as we go back to the second segment where we talked about global tourism. Well, China was a big part of that global tourism as well. These individuals, one, no longer need that local currency, which is going to be a slight headwind to the tailwinds that are supporting some of it in terms of those dollar shortages, which we'll talk about this weekend. But the outbound tourist continues to fall, and Golden Week is going to be a very important piece because typically during this time period, you travel within country and outside the country. And we just don't think that that's going to come through again, which is going to put additional weight and is showing that the local consumer remains under pressure given jobs, benefits, payments. And this is that weird backdrop in terms of what is the consumer doing as we see a huge amount of a huge increase in terms of leverage and a drop in spending within China itself. Now, doing a quick report card on what is happening with the U.S.-China trade deal. Shocker, it's not good. It's failed to meet any expectations. They continue to track well below it. Bloomberg just put out their own numbers that are very similar to what we're seeing right here. And this is factoring in a big increase in grains from July into August. Given August into September, we saw additional grain exports. We saw additional oil purchases. But given some of the depressed levels and just some of the different components, they're just not going to get to that number. And it's not only because they're not buying enough, but it's measured in dollar amount, not in tonnage. So as prices have come down, that means you have to buy more, and it isn't going to happen. And given, as we said when we first started the show and when we first started talking about, and I was doing the write-ups as I still do twice a month, we're not going to get there. It was never going to happen. They already knew COVID was real. They already knew it was out there, and they signed a deal that they knew was going to be impossible to get into that backdrop. Now that we looked at the overall totals, let's look here in terms of what is the breakdown. Let's look at the different shifts. And now China imports at the first line. We can see the agriculture. Now, the agriculture has obviously picked up, but just based on the delta between where they should be right now and where they are, is just a mountain that they're not going to be able to climb, especially because they can buy from Brazil, they're buying from Russia, buying from Argentina. They have other optionality, especially as our prices have increased because Brazil is actually imported from Uruguay to backfill because they have so many soybeans that are flying off the shelf. And that's why there's just going to be an overall headwind. The manufactured goods, I think, is fairly given just based on that backdrop between imports increasing, exports decreasing, and that backdrop between exports and imports with China, and U.S. And that's being made up with manufacturing goods just isn't there, and it won't be. Energy is one where they're trying to close the gap, and good luck. I mean, even though we've talked about in the EIA show how China has been one of the biggest buyers over the last, let's call it 3 weeks, we're not going to get there, and there's no real way to close that gap, especially if they have a super cold winter. They're not going to be buying enough LNG or energy in general to close that gap, especially because they have such cheap feedstock they can get from Angola and other Middle Eastern countries. Exports, it's no surprise. U.S. exports continue to struggle, especially as they go into to China, and there's just not much in the backdrop, just given the softness that exists throughout the whole global economy. So that kind of wraps it up. I know we had some longer shows trying to cover the different dynamics and the inner workings of different parts of the world, which is always fun but challenging to try to do it in a short time frame. So thanks again for watching. On Friday, we're going to have our favorite, the primary vision frac spread count. And then we're going to put out that update on US dollar inflation, deflation, stagflation, really what comes next over the weekend. So thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.